Welcome to what I hope will become the most comprehensive fund selection series on YouTube. If you've ever looked at thousands of investment funds and wondered how professionals decide which ones deserve a place in a portfolio, then this series is for you. Because here is the reality. Millions of people spend decades working, saving, and contributing to pensions and investment accounts. They trust their fund managers, wealth managers, and investment professionals to make sensible decisions. The quality of those decisions can have a direct impact on their financial security, their retirement, and ultimately their quality of life. So fund selection is therefore not just about chasing performance tables or finding the latest top performing fund. It's about identifying skilled investment managers, understanding investment processes, managing risk, and allocating capital responsibly. In this video, I'm going to take you inside the professional fund selection process and show you how experienced fund selectors think about evaluating investment managers and investment funds. We will cover what fund selection actually is, why it matters, the role of a fund selector, and most importantly, how professionals assess the people and organizations responsible for managing investors' money. But before we begin, a quick introduction about me. My name is Shoaib Akhtar. I've spent more than a decade working in the investment industry and have been involved in fund selection and investment research for many years. I have also served on the judging panel for the Investment Week Fund Manager of the Year awards on multiple occasions, evaluating some of the most respected fund managers and investment firms in the industry. I'm the author of The Great British Disconnect, a book examining the challenges facing the UK stock market, and I'm currently writing a second book focused on fund selection and fund research process. Everything I'll discuss in this series is based on practical industry experience, real-world fund research, and frameworks used by professional investors when assessing investment managers. So if you are ready to learn how professional fund selectors evaluate funds and managers, let's get started. So what exactly is fund selection? At its simplest level, fund selection is the process of deciding which investment funds deserve a place within a portfolio. Now that sounds quite straightforward, but in reality, it's far more complex than most people realize. There are thousands of funds available to investors around the world. Equity funds, bond funds, multi-asset funds, absolute return funds, emerging market funds, small cap funds, income funds, growth funds, and everything in between, The challenge is that investors can't realistically analyze every company, every bond, or every security themselves. Instead, they delegate the responsibility to professional fund managers. The job of a fund selector is therefore to decide which fund managers are most likely to deliver a good outcome for clients. Notice, I didn't say the highest return. I said the best outcome. Because professional investing isn't simply about maximizing returns. It's about balancing risk and return. It's about consistency. It's about managing downside risk. It's about ensuring that clients can achieve their long-term financial objectives without taking unnecessary risk along the way. A good fund selector, therefore, acts as a gatekeeper. They sit between investors and fund managers. Their role is to identify skill, avoid unnecessary risks, and allocate capital to managers who demonstrate the right combination of talent, discipline, and process. Think about the responsibility involved. Many investors spend 30 or 40 years contributing to pensions and investment accounts, right? Some are saving for retirement, some are saving for their children's future. Others are relying on their investment to generate income later in their life. So every allocation decision has consequences for the end client. Selecting the wrong manager can damage those outcomes. Selecting the right manager can materially improve them. That's why fund selection is such an important discipline within the investment industry. And it's also why professional selection involves much more than simply looking at performance tables alone. In fact, one of the biggest misconceptions amongst retail investors is the belief that the best performing fund is automatically the best fund. Professional fund selectors know that performance is only one piece of the puzzle. Often, the most important questions are not about performance at all. They are about people. Who is managing the money? How do they make decisions? What investment philosophy do they follow? What resources do they have available? How stable is the organization behind them? But before we analyze numbers, before we look at performance stats, and before we compare funds, we first examine the people and organization responsible for managing investors' capital. So, how do professional fund selectors separate good managers from average managers? One of the biggest differences between professional and retail fund analysis is where the process begins. Most retail investors start by looking at performance. How much money can I make out of it? They open a fact sheet, sort a table by returns, and immediately focus on the funds that have performed best over the last 1, 3, or 5 years. Professional fund selectors often do the opposite. They start with the people, because before you can judge the results, we need to understand who actually produced those results and how they were achieved. After all, a strong performance number on its own tells us very little. Was it skill? Was it luck? Was it excessive risk taking? Was it a favorable market environment that may never be repeated? The only way to answer those questions is to understand the people, the team, and the organization behind the fund. Over the years, I have found that when evaluating fund managers, there are 7 key areas that consistently deserve attention. To help structure the process, I use a framework called Masters. M stands for manager quality, A stands for alignment of interest, S for structure of the firm, T for tenure and track record, E for expertise and specialization, R for resources and team, and the final S stands for succession planning. Now, that isn't just a box ticking exercise. No manager is going to score perfectly in every single category. The purpose of this framework is to help us build a complete picture. Because fund selection is really about finding perfection. It's about identifying strengths, recognizing weaknesses, and deciding whether we have sufficient confidence in the people responsible for managing our clients' money. So let's start with the first and arguably the most important element of this framework: management quality. Let's start with M. If there's one lesson I want you to take away from this video, it's this: funds don't make investment decisions, people do. Behind every fund is a human being, or sometimes a team of human beings, making decisions every single day about where to allocate capital, what risks to take, and what opportunities to pursue. That's why manager quality is often the first thing I assess when researching a fund. The question I'm trying to answer is rather simple. Would I trust this person to manage my family's money? Now, that might sound obvious, but it's remarkable how often investors skip this step entirely. Instead, they focus on performance charts, ratings, and league tables without ever asking who is actually responsible for generating those results. When assessing management quality, I want to understand several things. The very first thing I want to understand is, what is this person's investment philosophy? Every successful fund manager should be able to explain clearly, articulately how they think about investing. Are they value investors, growth investors, quality focused investors, income investors? What's their actual edge? What gives them a reason to believe they can outperform competitors over the long term? One of the biggest warning signs in fund selection is when a manager can't clearly articulate their investment philosophy. Because if they don't understand exactly why they invest the way they do, how can investors have confidence in the decisions being made? The second thing I look for is consistency. Has the manager followed the same philosophy over time, or have they constantly changed their approach depending on what's fashionable in the market? The best managers often display remarkable consistency. Markets change, right? Economic conditions change, but their core investment philosophy remains largely intact. I also want to understand how decisions are made. Is the manager genuinely responsible for portfolio construction? Or are the decisions being made by a committee? How much autonomy do they actually have? How much influence do analysts have within the process? These questions help us understand who is really driving the investment outcomes. Remember, when you are selecting a fund, you are not simply buying a product. You are placing your trust in the judgment, discipline, and decision-making ability of another human being or a group of human beings. And that's why manager quality sits at the very foundation of the entire fund selection process. The second component of the framework is A, which stands for alignment of interests. This is one of the most overlooked areas of fund selection in my view, particularly amongst retail investors. Yet, in many cases, it can tell you a great deal about how a manager is likely to behave over the long term. The principle is quite simple. People respond to incentives, right? In every industry, incentives influence behavior, and the investment industry is no different at all. When I'm researching a fund manager, one of the first questions I ask, are the manager's interests aligned with the interests of the end clients? In other words, do they benefit when investors benefit, or are they being rewarded for something else? One of the strongest signals of alignment, in my view, is what we call skin in the game. Does the manager invest their own money in the fund that they manage? If they do, that doesn't automatically make them a great investor, but it does tell us something very important. It tells us that they experience the same gains and losses as their clients, so their personal wealth is exposed to the same decisions that they are making on behalf of investors. This creates a powerful alignment of interests, right? The next area that I look at is remuneration structure. How is the manager rewarded? Are incentives linked to long-term outcomes, or are they primarily linked to gathering lots of assets? Because these can be very different objectives. A manager whose compensation depends largely on attracting more assets may behave very differently from the one whose compensation depends on delivering long-term investment results. This brings us to another very important consideration. Who owns the business? Is it privately owned investment boutique, or is it a listed company? Is it part of a large financial institution? Ownership structures can influence culture, priorities, and decision making. For example, some boutique firms are built entirely around investment excellence. Some larger organizations may have different priorities, including shareholder expectations, revenue growth, and commercial targets. Neither model is automatically better, but understanding the structure helps us understand the incentives operating within the organization. I also pay attention to staff ownership. Do senior investment professionals own shares in the business? Are they long term stakeholders or are they simply employees? Again, this helps us understand whether decision makers are thinking like owners or thinking like employees. Ultimately, what we are trying to determine is whether everyone involved is rowing in the same direction. Because when incentives are properly aligned, managers, firms, and clients all benefit from the same thing: strong long term outcomes. And when, and when incentives become misaligned, problems often follow. That's why understanding alignment of interest is not a nice to have consideration. It's a fundamental part of professional investment selection. The first S in the Masters framework stands for structure of the firm. Now, this is an area many investors completely overlook. They focus on the actual fund, they focus on the manager, but they rarely stop to think about the organization sitting behind them. The reality is that even the most talented fund manager doesn't operate in isolation. Every investment decision is made within the context of the wider organization. That organization provides the research, technology, risk oversight, compliance support, and operational infrastructure that allows the investment process to function. So, when I'm evaluating a fund, I'm not just assessing the manager, I'm assessing the firm. So, the first question I ask is, what type of organization I am dealing with here? Is this a specialist boutique? Or is it a large global asset manager? Or is it part of a bank or insurance company? Or is it an independent investment house? Each structure comes with its own strengths and weaknesses. Boutique firms often benefit from focus, in my view. They may specialize in a particular asset class, investment style, or a particular market segment. Their culture is often built entirely around investing. Large organizations, on the other hand, may have access to significantly greater resources, larger research teams, and broader global capabilities. Neither approach is inherently superior. The key is understanding how the structure supports the investment process. The next thing I examine is stability. How long has the firm been operating for? Has it survived multiple market cycles? Has it maintained a consistent identity over time? Or has it been through repeated acquisitions, restructuring, and ownership changes? Because organizational instability can eventually offset investment outcomes. If key personnel are constantly leaving, if teams are frequently recognized, or if ownership changes every few years, it becomes harder to maintain a consistent investment culture. Culture itself is another critical factor. When I meet managers, I'm often trying to understand what the organization really values. Does it prioritize investment excellence? Does it encourage investment thinking? Does it reward long term investment decision making? Or is the focus primarily on sales, asset gathering, and commercial growth? Understandably, culture can be difficult to measure, but over time, it often reveals itself through staff retention, investment discipline, and consistency of the investment process. I also look at whether the firm genuinely specializes in the area where the fund operates. For example, if I'm researching a fixed income strategy, I want to know whether the organization has a strong heritage in fixed income investing. If I'm looking at an emerging markets fund, I want to understand the firm's expertise and commitment to that particular asset class. Specialization doesn't guarantee success, by the way, but Organizations that have spent decades developing expertise in a particular area often possess advantages that are difficult for competitors to replicate. Ultimately, what we are trying to determine is whether the organization creates an environment where talented investors can perform at their best. Because great managers are very important. But great managers supported by great organizations are even more powerful. And that's why understanding the structure of a firm forms an essential part of the professional fund selection process. The T in the Masters framework stands for tenure and track record of the fund manager. Now, at first glance, this might seem like one of the easiest areas to analyze. After all, performance data is readily available, right? You can look at the returns over 1 year, 3 years, 5 years, or even longer. But in reality, this is one of the areas where investors can make some of the biggest mistakes. Because experience and track record are not necessarily the same thing. Let's start with tenure. One of the first questions I ask is how long has this manager actually been running this strategy? Not how long they have worked at the particular firm, not how long they have worked in the industry, how long they have actually been responsible for making investment decisions within this particular fund. The reason this matters is simple. When we evaluate performance, we want to ensure the individual we are assessing is actually responsible for the results we are looking at. If a manager took over a fund 18 months ago, for instance, then a 10-year performance chart may tell us very little about their own ability. We are effectively judging someone else's work. That's why manager tenure is so important. We need to know who generated the actual track record. The next thing I consider is experience of the fund manager. How many market cycles has the manager lived through? Have they experienced periods of market stress? Have they managed money during recessions, financial crises, interest rate shocks, or periods of extreme volatility? Because investing often looks easy during favorable markets. The real test comes when conditions become quite difficult. One of the things I learned early in my career is that bull markets can make people look like investment geniuses. Bear markets tend to be far more revealing. That's why I place significant value on managers who have demonstrated discipline across multiple market environments. Now let's talk about the track record. Performance is important, very important of course, but professional fund selectors rarely stop at the headline return number. Instead, we ask a rather deeper question. How were those returns actually generated? Were they achieved consistently? Were they achieved through skill? Or were they simply the result of being in the right place at the right time? For example, imagine two managers who both delivered identical returns over the last 5 years. At first glance, they might appear equally attractive, but when we look beneath the surface, we may discover that one manager generated those returns through a disciplined and repeatable process, while the other achieved them by taking significantly greater risks. These are very different outcomes, and they may lead to very different future results. Another important consideration is the environment in which that performance was achieved. A growth manager may look exceptional during a period when growth stocks dominate markets, right? A value manager may struggle during exactly the same period. That doesn't automatically mean one manager is more skilled than the other. Sometimes market conditions favor certain styles and penalize others. That's why context matters. The best selectors are not simply evaluating performances. They are evaluating performance in context. Ultimately, tenure and track record help us answer a critical question. Has this manager demonstrated the experience, consistency, and discipline necessary to earn our confidence over the long term? Because whilst past performance doesn't guarantee future results, understanding how that performance was actually achieved can tell us a great deal about the quality of the investment process behind it. The E in the Master's framework stands for expertise and specialization. Now, this may sound obvious, but it's an area that deserves much more attention than it often deserves, in my view. One of the assumptions investors sometimes make is that successful investors can successfully manage any type of strategy. In reality, investing is highly specialized business. The skills required to manage a UK small cap fund are very different from those required to manage an emerging market debt portfolio. Managing a global equity strategy is different from managing a high yield bond strategy, for instance. And managing a concentrated growth portfolio requires a different mindset from managing a diversified income portfolio. That's why one of the questions I always ask is this: what does this manager genuinely specialize in? What is their area of expertise? What have they spent years or even decades studying and investing in? The best managers often develop deep knowledge within a particular area of the market. They understand the key drivers of returns. They understand the risks. They understand the competitive landscape. And perhaps most importantly, they understand what can actually go wrong. When I assess a manager's expertise, I want to understand their journey. How did they actually get here? What roles have they held previously? What sectors have they actually covered? What markets have they invested in? What experience have they accumulated over time? Because expertise is rarely built overnight. It is usually the result of years of research, analysis, mistakes, lessons, and continuous learning. I also look for evidence that the organization itself supports that sort of specialization. For example, if a firm claims to be a leading fixed income specialist, I would expect to see significant resources dedicated to fixed income research, right? If a firm specializes in emerging markets, I would expect to see deep regional knowledge, experienced analysts who can speak the language, and a long-standing commitment to that particular asset class. The key point is that specialization should be visible throughout the organization, not just the marketing material. One of the dangers investors face is what I sometimes call style tourism. This is when firms move into popular areas simply because demand is strong. A firm known for one investment discipline suddenly launches products in completely different areas because investors are interested in them. That doesn't automatically mean those products are poor, but it does mean we should ask additional questions. Do they genuinely possess the expertise required, or are they expanding beyond their traditional strengths? As fund selectors, our objective is not simply to find capable investors. It is to find investors operating within areas where they possess a genuine competitive advantage. Because the most successful managers are often not those who try to do everything. They are the ones who know exactly what they do well and remain disciplined enough to stay within their circle of competence. And that's an important lesson for investors as well. Sometimes expertise is not about knowing everything. It's about knowing exactly where your expertise begins and where it ends. The R in the Master's framework stands for resources and team. Now, this is an area that has become increasingly important, particularly over the last few decades. The image many people have of investing is often that a star fund manager sitting alone in an office making brilliant investment decisions. The reality is usually very different. Modern investing is often a team sport. Behind every successful investment manager, there may be analysts, economists, sector specialists, quant researchers, risk professionals, trade and portfolio construction experts, all contributing to the investment process. That's why when I'm evaluating a fund manager, I'm rarely evaluating the manager alone. I'm evaluating the entire ecosystem that supports them. One of the first questions I ask is, what resources are available to the investment team? How many analysts support this particular strategy? What research capabilities exist within the organization? How are investment ideas generated? How are those ideas challenged internally? How are risks monitored? Because even the most talented investor has limitations. No individual can know everything. No individual can analyze every company, every industry, and every macroeconomic development in isolation. Strong investment teams recognize this reality. They build processes that allow different perspectives to be considered before investment decisions are made. I also pay close attention to the quality of the team itself. How experienced are the analysts? How long have they worked together? Is there stability within the wider team, or is there constant turnover? One of the things I have learned over the years is that team stability can tell you a great deal about an organization. When talented people choose to stay together for a long time period, it often suggests a healthy culture, a well-functioning investment process. Frequent departures, on the other hand, may indicate deeper issues that deserve further investigation. Another area I examine is what we call key person risk. This is the risk that too much of the investment process depends on a single individual. If one manager leaves tomorrow, what happens to the strategy? Would the investment process continue largely unchanged, or would investors effectively be left with an entirely different proposition? The stronger organizations usually have depth. They have experienced teams. They have robust processes. And they have multiple individuals capable of contributing to decision making. That's not because great managers aren't important. They absolutely are. But the best investment organizations are often built in a way that makes them resilient. Success is not dependent on one person having a good day. It is supported by a team, a process, and a culture that can endure over time. As fund selectors, that's exactly what we are looking for. Not just talent, but sustainable talent. Not just a single strong individual, but a strong organization capable of supporting that individual for years to come. Because ultimately, clients are investing for the long term, right? And the investment team needs to be capable of delivering over the long term as well. The final S in the Master's framework stands for succession planning. And in my experience, this is one of the most underappreciated aspects of fund selection. Investors spend a lot of time evaluating who is managing the fund today. Far fewer spend time thinking about who might be managing it tomorrow. Yet, fund management is ultimately a people business. People retire, people change firms, people change roles, and sometimes people leave unexpectedly. So one of the questions I always ask is this: what happens if the lead manager is no longer there? Now that might sound like a pessimistic question, but it's actually a very practical question. Because if the success of a fund depends entirely on one single individual, then investors are exposed to a significant amount of risk. This is particularly important when evaluating managers who have built exceptional reputations over many years or even decades. And in some cases, the manager becomes synonymous with the fund itself, sort of a star manager. Investors buy the fund because they trust that particular individual. The challenge is that no investment career lasts forever. At some point, every successful manager will eventually step away. And when that happens, investors need confidence that the strategy can continue successfully. That's why I pay close attention to succession planning. Is there a deputy manager? Is there a co-manager? Are there experienced team members who have worked alongside the lead manager for many years? Has responsibility gradually been shared across the wider team? Or does everything appear to revolve around one person? The strongest organizations usually think about succession years in advance. They develop talent internally. They provide opportunities for younger investors to take on greater responsibility. And they ensure that knowledge is transferred throughout the organization rather than being concentrated in a single individual. I also pay attention to the age and career stage of key decision makers. Now, this isn't about discriminating against older managers. Far from it. Some of the best investors in the world have delivered exceptional results over a very long time. If a manager is approaching retirement, it's entirely reasonable to ask what the transition plan looks like. Who will be taking over? How prepared are they? And how much confidence should investors have in the next generation of leadership? Ultimately, succession planning is really about resilience. Can the investment process survive change? Can the organization continue delivering strong outcomes even when key individuals move on? Because investors are making long-term commitments. Pension investors may be invested for decades. Endowments may be invested for even generations. The organizations managing that capital need to think with the same long-term perspective. And that's why succession planning forms the final component of the Master's framework. It is the final check that helps us determine whether a strong investment organization is built to endure, not just today, but for many years into the future. Now, if you've been paying attention, you will notice that everything we've discussed so far has focused on people and organization. We have looked at the manager, we have looked at the team, we have looked at the incentive structure, we have looked at the structure of the firm itself, and we have looked at whether the organization is built to endure over the long term. But there is another important question we need to answer. Even if we identify a highly talented manager working within a strong organization, how do they actually invest? Because ultimately, investing is not just about who is managing the actual money. It's about how money is being managed. This is where we move beyond the people and start examining the investment approach itself. As fund selectors, we are trying to understand whether there is clear and repeatable framework behind the decisions being made. Is there a detailed investment philosophy? Is there a disciplined investment process? Does the manager remain true to that philosophy over time, or do they change their approach whenever the market conditions become challenging? These questions are incredibly important because consistency is often one of the defining characteristics of successful long-term investors. Many managers can perform well for a year. Some can perform well for several years even. But maintaining discipline through changing market environments is much harder. That's why the next stage of the fund selection process involves examining the manager's investment philosophy, investment process and the degree to which they remain faithful to both. Because before we analyze performance, we first need confidence that there is a robust and repeatable process generating that particular performance. So let's start with investment philosophy. Now, this may sound like a slightly abstract concept, but in reality, it sits at the heart of every successful investment strategy. A fund manager's investment philosophy is simply their core belief about how markets work and where investment opportunities come from. In other words, what do they actually believe? Why do they actually believe it? And what gives them confidence that their approach can deliver attractive long-term outcomes? For example, some managers believe that undervalued companies eventually become recognized by the market. Those managers are often described as value investors. Others believe that high-quality businesses continue growing for many years and are willing to pay higher valuations for those companies. Those managers are often described as growth investors or quality investors. Others focus on income generation. Some focus on momentum. Some focus on quality, at a sustainable growth rate. So which philosophy is right? The important point is whether the philosophy is clear, coherent, and consistently applied. One of the first things I look for when meeting a fund manager is whether they can clearly articulate their philosophy. Can they explain their approach in a simple and convincing manner? I might be repeating myself a little here, but it's important. Can they believe why they believe it works? Can they explain the environments in which it is likely to succeed, and just as importantly, the environments in which it may struggle? Because every investment philosophy has strengths and weaknesses. Every investment philosophy experiences periods of outperformance, and every investment philosophy experiences periods of underperformance. Managers who understand this tends to have deeper understanding of their own process. One of the biggest warning signs for a fund selector is when a manager appears to be changing their philosophy or process depending on market conditions. For example, imagine a manager who presents themselves as a disciplined value investor. Then a growth rally occurs, tech stocks surge, artificial intelligence becomes dominant theme in markets as we have seen over the last decade and a half, and suddenly the portfolio starts looking increasingly like a growth fund. At that point, a fund selector has to ask an important question. Has the manager genuinely identified a new opportunity, or have they abandoned their philosophy in order to chase performance or to keep those assets? Because style drift is one of the most common issues encountered in fund selection. Investors often buy funds for a specific purpose. They expect a value fund to behave like a true value fund. They expect an income fund to behave like an income fund, And they expect a small cap manager to remain focused on small cap opportunities, because that is where their strength lies. When managers move away from their stated investment philosophy, those expectations can be disrupted. And that's why understanding investment philosophy is so important. We are not simply trying to identify managers with strong views. We are trying to identify managers with strong views that remain consistent through changing market environments. Because in many cases, the philosophy is the foundation upon which the entire investment process is built. And if the philosophy changes every few years, investors should question whether there is a genuine process in place at all. Once we understand our manager's investment philosophy, the next step is to understand their investment process. And this is an important, very important distinction. Investment philosophy tells us what the manager believes. Investment process tells us how those beliefs are translated into actual investment decisions. In simple terms, Philosophy is the theory, process is the actual execution. Because having a good idea is one thing, consistently implementing that idea across hundreds of investment decisions is something else entirely. One of the first questions I ask when researching a fund is, how are ideas generated? Where do opportunities actually come from? Are they sourced through fundamental research, quantitative screening, industry contacts, macroeconomic analysis, or some sort of combination of all of this? The next question is equally important. Once an idea has been identified, what happens next? What research is undertaken? What level of due diligence is required before capital can be deployed? What risks are considered? What challenges are made to the original investment thesis? Because strong investment organizations tend to have structured processes. They don't rely on intuition alone. They don't rely on gut feeling. They have repeatable frameworks that help ensure decisions are made consistently over time. As fund selectors, one of the things we are looking for is evidence that the process is robust. Could another member of the team follow the same process? Could the process survive a difficult market environment? Could the process survive changes within the team? Because ultimately, we are trying to identify repeatability. One of the reasons this matters is that good performance can sometimes occur by accident. A manager may benefit from favorable market conditions. They may benefit from a particular theme becoming popular. They may benefit from being positioned in the right place at the right time. But a well-defined process is often what separates luck from skill. A robust process gives us confidence that future investment decisions will be made using the same disciplined framework that generated previous results. Another important area to examine is whether the manager follows the process they actually describe. This may sound obvious, but it is surprisingly important in my view. Many managers can explain their investment process. Far fewer demonstrate consistent adherence to it over time. As fund selectors, again, we therefore spend a significant amount of time looking for that sort of evidence. Does the portfolio reflect the stated investment philosophy? Do the holdings make sense given the investment approach? Does the portfolio continue to look broadly consistent from one reporting period to the next? Or does the strategy appear to change depending on what is currently performing well in the market? Because consistency between philosophy, process, and portfolio construction is often one of the strongest indicators of investment discipline. And discipline is one of the qualities professional fund selectors value the most. The objective is not to find managers who are always right. Far from it. No manager is always right, The objective is to find managers who consistently apply a repeatable process over long periods of time. Because over the long run, it is usually the quality of the process that drives the quality of the outcomes. Once we understand our manager's investment philosophy, the next step is to understand their investment process. Another area I pay close attention to is the portfolio turnover. How frequently are positions changing? Are holdings being bought and sold at a pace that is consistent with the stated investment approach? Or does the portfolio appear to be constantly changing direction? Now, high turnover is not automatically a bad thing, it's worth mentioning here. Certain strategies naturally involve high levels of activity. Others are designed to be long-term in nature, The important part is consistency. The portfolio should behave in a manner that aligns with the philosophy and process being described. As fund selectors, we are always looking for alignment. alignment between philosophy and process. Alignment between process and portfolio, and alignment between what the manager says and what the manager actually does. Because when these elements remain consistent over time, confidence tends to increase. When those elements begin to diverge, further investigation is usually required. Ultimately, one of the strongest indicators of investment discipline is not what a manager says during a meeting. It's what they continue doing when markets become difficult, when styles fall out of favor, and when performance comes under pressure. That's when you discover whether a philosophy is genuinely held or merely a marketing slogan. And that's why style consistency forms such an important part of the fund selection process. The next area I want to examine is fund capacity. And this is a topic that often surprises many investors because one of the assumptions many people make is that bigger is always better. In reality, that's not necessarily true. In fact, one of the greatest challenges faced by successful fund managers is managing their own success. As a fund grows, the investment opportunity set available to that manager can begin to shrink. Why? That should be the natural question. Because capital itself can become a constraint. Let's take a simple example. Imagine you are managing a small cap fund with about 200 million of assets. You may have access to a very large universe of potential investments, right? You can establish meaningful positions in smaller businesses without materially affecting the broader market. Now imagine that the same fund grows to 5 billion or 10 billion. Suddenly things become much more complicated. Many of the smaller opportunities that once looked attractive may no longer be practical. The manager may struggle to find positions without influencing the share price. They may struggle to exit positions efficiently, and in some cases, they may be forced to focus on larger companies simply because there are fewer liquidity constraints. At that point, investors need to ask an important question. Has the size of the fund started to affect the manager's ability to execute their strategy? Because every strategy has a natural capacity limit, right? Some strategies can absorb enormous amounts of capital, others can't. A global large cap equity strategy may have significant capacity because the underlying securities are highly liquid. A microcap strategy, on the other hand, may have considerably less capacity because the investment universe is much smaller. As fund selectors, we are therefore trying to understand whether assets under management remain appropriate for the strategy being pursued. Has the manager discussed capacity constraint? Do they actively monitor them? Have they previously closed funds to new investors when capacity became stretched? Or are assets continuing to grow regardless of the potential impact on future performance? These questions can tell us a great deal about the priorities of the organization. Because sometimes the most investor-friendly decision a manager can make is to stop accepting new money. That decision may reduce short-term revenue for the firm, but it can help protect long-term outcomes for existing investors. Ultimately, fund capacity is about preserving flexibility. The larger a fund becomes, the harder it may become to exploit certain opportunities. Because a strategy that worked exceptionally well at about 200 million may behave very differently at 10 billion. And understanding that relationship between assets and opportunity is an important part of professional fund selection. Closely related to fund capacity is another important concept, liquidity. Now, liquidity is one of those terms that gets used frequently within the investment industry, but it's not always well understood. In simple terms, liquidity refers to how easily an investment can be bought or sold without significantly affecting its price. Highly liquid assets can generally be traded quickly and efficiently. Less liquid assets can be much more difficult to buy or sell, particularly during periods of market stress. Now that we have discussed liquidity, it's worth spending a few minutes talking about fund structures. Because one of the things many investors discover quite late in their investment journey is that not all funds are built in the same manner. In fact, the structure of a fund can have a significant impact on how it operates, how investors access their money, and how certain risks are managed. Broadly speaking, most investors will encounter a number of different fund structures. These include open-ended funds such as OEICs and unit trusts, exchange-traded funds, commonly known as ETFs, and closed-ended structures such as investment trusts. Now, the purpose of this video is not to provide a detailed technical explanation of each structure. We can cover that in any future videos. But I think it's important to understand the basic differences because those differences can influence investment outcomes and investor experience. For example, many traditional funds operate on an open-ended basis. When investors put money into the fund, new units are created. When investors withdraw their money, units are cancelled. The size of the fund therefore expands and contracts depending on investor demand. This structure works extremely well for many types of investments. However, it can create challenges when the underlying assets are less liquid. By contrast, investment trusts operate differently. They are typically closed-ended structures, meaning the number of shares in issue is generally fixed. Investors buy and sell shares from one another through the stock market rather than dealing directly with the fund manager itself. This can reduce some of the liquidity pressures faced by open-ended funds, although it introduces other considerations such as discounts and premiums to the net asset value. Then we have ETFs, which have become increasingly popular over recent years due to their transparency, accessibility, and typically lower costs. Again, ETFs have their own advantages and considerations which deserve separate discussion. The important takeaway at this stage is simply this. The fund structure matters, yes, but two funds may invest in similar assets. Two funds may even be managed using similar investment philosophies. Yet, the structure itself can influence liquidity, pricing, investor behavior, and risk management. That's why professional fund selectors always seek to understand not only the portfolio, but also the vehicle through which that portfolio is being delivered. Because structure is another piece of the puzzle. And like every other piece we have discussed so far, it helps us build a more complete picture of the overall investment proposition. Because when investors allocate capital to a fund, they often assume they can access their money whenever they choose. However, the ease with which investors can redeem their investment ultimately depends upon the liquidity of the underlying assets held within the portfolio. Let's consider a simple example. A fund investing in large, globally traded companies may have relatively few liquidity concerns. The underlying securities trade every day. There are usually numerous buyers and sellers. Positions can often be adjusted without significantly affecting price markets. Let's consider a simple example. A fund investing in large, globally traded companies may have relatively few liquidity concerns. The underlying securities trade every day. There are usually numerous buyers and sellers. Positions can often be adjusted without significantly affecting market prices. Now compare that with a fund investing in very small companies or specialist areas of the market. or securities that trade infrequently. The situation becomes very different. During normal market conditions, liquidity may appear perfectly adequate, but during periods of market stress, liquidity can deteriorate rapidly. Buys suddenly disappear, trading volumes fall, and assets that previously appeared easy to sell suddenly become much harder to exit. As fund selectors, we therefore need to understand whether the liquidity profile of the portfolio is appropriate for the structure of the fund. Do the underlying assets provide sufficient liquidity? Could the manager meet redemption requests during difficult market conditions? Would they be forced to sell assets at unfavorable prices? These are important questions because liquidity risk often remains hidden until markets become stressed. In strong markets, liquidity rarely attracts much attention, but in difficult markets, it can become one of the most important risks within a portfolio. I also pay close attention to the relationship between liquidity and position sizing. A manager can identify an attractive investment opportunity, right? But if the security is relatively illiquid, there are practical limits to how much capital can sensibly be invested. This brings us back to one of the recurring themes within fund selection. A good investment idea is only valuable if it can be implemented effectively. And implementation is often constrained by practical considerations such as liquidity. Ultimately, liquidity is about flexibility. It influences how managers enter positions, how they exit positions, how they manage risk, and how they respond during periods of market stress. That's why professional fund selectors spend considerable time understanding not only what a fund owns, but also how easily those investments can be traded when conditions become challenging. Because liquidity may appear unimportant when markets are calm, but it often becomes critically important when markets are not. So far, we've spent a considerable amount of time discussing the qualitative side of fund selection. We have examined the people managing the money. We have looked at the organizations supporting them. We have discussed investment philosophy, investment process, style consistency, fund capacity, liquidity, and fund structures. In many ways, we've been trying to answer a very simple question. Do we have confidence in the manager and the investment process? But eventually, every fund selector reaches a point where another question needs to be answered. What do the results actually look like? Because no matter how impressive a manager may appear in meetings, no matter how compelling their philosophy may sound, and no matter how robust their process appears, we ultimately need to evaluate outcomes, actual outcomes. This is where quantitative analysis enters the picture. Now, one of the biggest misconceptions amongst investors is that quant analysis simply means looking at performance. In reality, professional fund selectors are usually interested in something much deeper. Not just how much money did the manager make, but how much risk was taken to generate those returns. How consistent were those returns? How did the manager behave during difficult markets? Did investors receive adequate compensation for the risks they accepted? Because performance alone can be misleading. Two funds may generate exactly the same return. One may have delivered that return smoothly and consistently. The other may have subjected investors to significant amount of volatility and large drawdowns along the way. From a professional fund selection perspective, those are two very different outcomes. This is why risk-adjusted analysis plays such an important role within the fund selection process. The objective is not simply to find managers who have generated strong returns. The objective is to identify managers who have generated attractive returns relative to the risks they have taken. And to help us do that, the investment industry has developed a number of statistical measures that allows us to compare managers on a more consistent basis. Some of the most widely used include the Sharpe ratio, the Sortino ratio, and the information ratio. Each of these measures attempts to answer a slightly different question. Each has strengths, each has weaknesses, and each can provide valuable insights when used correctly. Let's begin with perhaps the most widely recognized risk-adjusted performance measure in the investment industry, the Sharpe ratio. If you have spent any time researching funds, you have almost certainly come across this metric. In fact, it is probably the most widely used risk-adjusted performance measure in our industry. But despite its popularity, many investors either misunderstand it or place far too much emphasis on it in isolation. So what exactly is the Sharpe ratio? At its simplest, the Sharpe ratio measures how much return a manager has generated for each unit of risk taken. In other words, it attempts to answer a very important question: how efficiently a manager has converted risk into return. Because generating returns is relatively easy if you are willing to take enough risk. The real challenge is generating attractive returns without taking excessive risk. That's what the Sharpe ratio is trying to capture here. Now look at a simple example. Imagine we have two funds. Fund A has generated an annualized return of 10%. Fund B has also generated similar amount of return. Looking purely at the performance, they appear identical. But let's assume Fund A achieved that return with significantly lower volatility than Fund B. In other words, investors experienced a smoother journey, smaller fluctuations, fewer unpleasant surprises. In that scenario, Fund A would generally have a higher Sharpe ratio than Fund B. Why? Because it generated the same amount of return while exposing investors to less risk. And from a professional fund selection perspective, that's quite important. Most investors don't experience returns in isolation. They experience the journey as well. The Sharpe ratio is a useful tool, but it's not a perfect tool. One of the biggest limitations is that it treats all volatility as risk. Whether prices move up or down, the Sharpe ratio views that movement as volatility. In reality, investors tend to be far more concerned about downside volatility than upside volatility, understandably. Most people don't complain when their investments rise too quickly. They complain when they fall. And that's one of the reasons why other measures, such as the Sortino ratio, were developed. Another important limitation is that the Sharpe ratio should never be viewed in isolation. A high Sharpe ratio doesn't automatically mean the manager is skilled, nor does a low Sharpe ratio automatically mean a manager is poor. Like all quantitative measures, it needs to be considered alongside philosophy, process, capacity, liquidity, and everything else we've discussed today. Because stats can help us ask better questions, but they rarely provide all the answers on their own. So while the Sharpe ratio is an extremely useful starting point for risk-adjusted analysis, it is only one piece of the puzzle. And that naturally brings us to the next metric, the Sortino ratio, a measure that attempts to solve one of the biggest shortcomings of the Sharpe ratio. At first glance, the Sortino ratio looks very similar to the Sharpe ratio. In fact, both metrics are attempting to answer the same broad question: how much return has a manager generated relative to the risk they have taken? However, the Sortino ratio approaches the problem slightly differently, and many investors argue that it does so in a more intuitive way. To understand why, let's briefly revisit one of the limitations of the Sharpe ratio. As we discussed earlier, the Sharpe ratio treats all volatility as risk. Whether prices move up or down, that movement contributes to the volatility calculation. But let's be honest, most investors don't lose sleep because their portfolio has risen too quickly. Most investors become concerned when it's the other way around. In other words, investors are generally more worried about downside risk than upside volatility. This is exactly the problem the Sortino ratio attempts to solve. Instead of penalizing all volatility, the Sortino ratio focuses primarily on downside volatility. It asks a slightly different question. How much return has the manager generated relative to harmful volatility? That's an important distinction, because a manager whose portfolio experiences strong upside movements may be penalized under the Sharpe ratio despite delivering an attractive investor experience. The Sortino ratio attempts to remove that issue by focusing attention on the downside risk. Let's consider a simple example. Imagine two funds that generate identical returns over a 5-year period. However, one fund experiences frequent and significant drawdowns along the way. The other fund experiences relatively few periods of negative performance. Although the headline returns may look similar, the second fund is likely to produce a higher Sortino ratio because investors experienced less downside risk. And from an investor's perspective, that distinction can be extremely important. This is one of the reasons why many professional fund selectors find the Sortino ratio particularly useful. It often aligns more closely with the way investors actually think about risk. Most clients are not concerned about volatility in the abstract. They are concerned about losing their actual money. They are concerned about drawdowns. They are concerned about periods where their portfolio falls significantly in value. The Sortino ratio, therefore, provides an additional lens through which we can evaluate fund managers' behavior. However, just like the Sharpe ratio, it's not a perfect measure. A high Sortino ratio shouldn't automatically be interpreted as evidence of superior skill. Nor should a lower Sortino ratio immediately disqualify a manager from consideration. Different styles naturally exhibit different return patterns. Certain strategies may experience periods of volatility that ultimately contribute to strong long-term outcomes. Others may appear exceptionally stable until a major market event exposes hidden risks. This is why professional fund selectors rarely rely on a single metric. Instead, we use multiple measures to build a more complete picture of risk and return. The Sharpe ratio tells us one story, the Sortino ratio tells us another story, and when viewed together, they often provide a richer understanding of how a manager has behaved over time. But there is still another important question we need to answer. Not how a manager performed in absolute terms, but how they performed relative to the benchmark they were trying to beat. And that's where the information ratio becomes extremely useful. So far, we have discussed the Sharpe ratio, the Sortino ratio. Both of these measures help us understand how efficiently a manager has generated returns relative to risk, and both can provide useful insights when evaluating investment performance. However, there is an important limitation here. Neither metric tells us whether the manager has actually added value relative to the benchmark they were hired to beat. They are not simply asking a manager to deliver market returns. They are asking the manager to outperform a benchmark, generate excess returns, and justify the additional costs associated with active management. This is where the focus of our analysis begins to shift. Up until now, we have largely been discussing returns in absolute terms. Now we are going to move into relative performance. In other words, how well did the manager perform compared with the benchmark? And perhaps even more importantly, how consistently did they outperform? Because from a fund selection perspective, there is a significant difference between a manager who occasionally outperforms through good fortune and a manager who repeatedly demonstrates skill over time. This is why many professional fund selectors place considerable emphasis on a metric known as the information ratio. In my view, particularly when analyzing active equity managers, the information ratio is one of the most useful performance measures available. Why? Because it doesn't simply ask whether a manager generated excess returns. It asks whether those excess returns were generated consistently, and consistency is often one of the strongest indicators of genuine investment skill. After all, almost any manager can outperform for a year. Many managers can outperform for 2 or 3 years. The real challenge is delivering excess returns repeatedly through different market environments while remaining true to the investment process we have already discussed throughout this video. That's exactly what the information ratio attempts to measure. So let's take a closer look at what the information ratio is and how it works, and why professional fund selectors often regard it as one of the most important tools when evaluating active managers. So what exactly is the information ratio? At its core, the information ratio measures a manager's ability to generate excess returns relative to a benchmark or an index on a consistent basis. Now, this might sound like a complicated concept, but actually it's quite straightforward. Let's start with the benchmark. Every active fund should have a benchmark against which its performance can be assessed. For instance, for a UK equity fund, that might be the FTSE All-Share Index. For a global equity fund, it might be the MSCI World Index. For an emerging markets fund, it could be the MSCI Emerging Markets Index. Right? All makes sense. The exact benchmark is less important than the principle. The benchmark represents the hurdle the manager is attempting to beat. Now let's imagine a manager outperforms their benchmark by, say, 2% in a given year. This sounds positive, but was that outperformance the result of skill, or was it simply luck? And if the manager outperformed this year, can they do it again next year and the year after that? This is where the information ratio becomes very useful. The information ratio looks at two things simultaneously. First, how much excess return the manager has generated relative to the bench. And second, how consistently that excess return was delivered. In other words, it doesn't just reward outperformance, it rewards repeatable outperformance. And that's a very important distinction. Let's imagine two managers. Both outperform their bench by 2% per year over a 5-year period. At first glance, they appear equally skilled, but when we look beneath the surface, we discover something quite interesting. The first manager beats the bench by a relatively consistent amount each year. The second manager significantly outperforms in some years, significantly underperforms in others, and arrives at the same average result through a much less consistent journey. From a fund selection perspective, most professionals would generally have greater confidence in the first manager. Why? because consistency often provides stronger evidence of process and discipline. The information ratio helps us identify exactly that. Higher information ratios are generally considered more attractive because they suggest a manager has been able to generate excess returns in a more reliable and repeatable manner. Lower information ratios suggest that excess returns have been less consistent and potentially more dependent upon favorable market conditions or individual outcomes. This is one of the reasons why the information ratio is particularly useful when evaluating active managers. Unlike the Sharpe ratio and the Sortino ratio, which focus primarily on absolute returns and risk, the information ratio focuses directly on active management skill. It asks a simple question: has the manager justified their active management decisions? Have they delivered value beyond what investors could have achieved simply by buying the bench? And for professional fund selectors, that's often one of the most important questions of all. However, there is another metric that sits very closely alongside the information ratio. In fact, it's impossible to fully understand the information ratio without understanding it. That metric is called the tracking error. Although tracking error doesn't receive the same attention as metrics such as Sharpe ratio and information ratio, it's often one of the most important concepts in professional fund selection. In fact, it's almost impossible to properly interpret the information ratio without first understanding the tracking error. So what exactly is it? At its simplest, tracking error measures how differently a fund behaves relative to its benchmark. In other words, it measures the degree to which a manager deviates by the index they are attempting to outperform. Now let's think about that for a moment. If a manager owned exactly the same securities as the benchmark, in exactly the same proportions, then performance would be almost identical to the benchmark. Tracking error would be very low, understandably. In fact, that manager would effectively be behaving like an index fund. Another extreme, imagine a manager who builds a portfolio that looks completely different from the bench. Different sectors, different companies, different weightings. Performance may vary significantly from the index from year to year. Tracking error is not inherently good or bad. It's simply a measure of active risk. It tells us how different a manager is willing to be from the benchmark. A low tracking error manager is generally staying relatively close to the index. A high tracking error manager is taking larger active positions and making bigger bets away from the benchmark. Neither approach is automatically superior. The important question is whether the manager is being rewarded for taking that active risk. And this is precisely why tracking error and information ratio are so closely linked. Imagine two managers who both outperform their benchmark by 2% per year. At first glance, they appear equally impressive. However, if one manager achieved that result with a tracking error of 2%, while the other required a tracking error of 10%, many selectors would view those outcomes quite differently. Why? Because the first manager generated the same level of excess return while taking considerably less active risk. In simple terms, they were more efficient, and that's exactly what the information ratio attempts to capture. One way I often think about tracking error is to ask a very simple question. How different is this manager from the benchmark? Because ultimately, active managers are being paid to be different. If a manager is charging active management fees, but their portfolio looks almost identical to the index, investors may reasonably ask whether they are receiving genuine active management at all. This is where concepts such as closet indexing often enter the discussion. A closet indexer is a manager who claims to be active but in practice stays very close to the benchmark while still charging active management fees. Tracking error can sometimes help identify those situations. Ultimately, tracking error is not a measure of skill, but it's more of a measure of activity. It tells us how much active risk a manager is taking. The information ratio then helps us determine whether that active risk has been rewarded commensurately. And together, these two metrics form one of the most powerful combinations available when evaluating active fund managers. Because before we judge whether a manager has delivered value, we first need to understand how much are they willing to deviate from the bench in order to achieve it. The next metric I would like to discuss is called alpha. And if you've spent any time around professional investors, you have almost certainly heard this term before. In fact, entire careers have been built around the pursuit of alpha. But what exactly does it mean? At its simplest, alpha represents the excess return generated by the manager after adjusting for the risks they have taken. In other words, alpha attempts to measure the value added by the manager's decisions. It's often described as the manager's contribution to performance. The return that can't simply be explained by market movements alone. Let's consider another example. Suppose the benchmark generates a return of 8%, and suppose a manager delivers a return of 10%. At first glance, we might conclude that the manager has added 2% of value. But investing is rarely that straightforward, because we also need to consider the level of risk taken to achieve that result. Did the manager simply take on greater market exposure? Did they increase portfolio risk? Or did they genuinely identify superior investment opportunities? This is where alpha becomes quite useful. Alpha attempts to isolate the component of performance that can be attributed to manager skill rather than the general market movements. Positive alpha is generally viewed as a good thing. It suggests that the manager has added value beyond what might have been expected, given the risks taken. Negative alpha, on the other hand, suggests the opposite, understandably. It suggests that investors may have been better off achieving market exposure through a simpler and potentially lower cost alternative. Now, one of the reasons alpha is so appealing is that it aligns closely with the core objective of active management. Investors pay active management fees because they believe managers can generate alpha. They believe managers can identify opportunities that the broader market has overlooked. They believe managers can add value through security selection, portfolio construction, and risk management. Alpha is therefore one of the most direct attempts to measure whether that value has actually been delivered. However, as with every other metric we have discussed throughout this video, alpha should never be viewed in isolation. A manager may generate positive alpha during one particular period because a specific style is in favor, right? Another manager may experience temporary negative alpha despite remaining disciplined and consistent within a robust investment process. So context always matters. This is why professional fund selectors rarely make decisions based on a single number. Instead, alpha becomes one piece of a much bigger puzzle. We look at alpha alongside information ratio, alongside tracking error, alongside management quality, investment process, style consistency, and everything else we have discussed so far. Because fund selection is ultimately about building conviction from multiple sources of evidence, not relying upon a single statistic. And while alpha attempts to measure the manager's contribution to performance, there is another metric that helps us understand something equally important. How sensitive is the portfolio to movements in the broader market? And while beta is often mentioned alongside alpha, it answers a different question. Where alpha attempts to measure the value added by a manager, beta attempts to measure the portfolio's sensitivity to movements in the broader market. In simple terms, beta tells us how much a fund tends to move relative to its benchmark or the market. Think of it as a measure of market exposure. A beta of 1 generally suggests that the fund moves broadly in line with the market. If the market rises by 10%, we might expect the fund to rise by roughly the same amount. Likewise, if the market falls by 10%, we might expect the fund to experience a similar decline. A beta above 1 suggests that the fund is generally more sensitive to market movements. In rising markets, that may lead to stronger gains, but in falling markets, it may also result in larger losses. Conversely, a beta below 1 suggests that the portfolio may be less sensitive to market movements. The fund may participate less in strong market rallies, but it may also provide some degree of protection during market downturns. Now, this is where beta becomes particularly useful for fund selectors, because not all returns are created equally. Suppose a manager has delivered impressive performance over the last 5 years. At first glance, that sounds rather encouraging, right? But if those returns were achieved simply because the manager took significantly more market risk than the benchmark, the picture starts to look quite different. Perhaps the manager wasn't generating exceptional stock selection. Perhaps they simply increased the portfolio's exposure to market movements. Beta helps us understand that distinction. It helps us identify whether returns are being driven by manager skill or by higher market sensitivity. This is particularly important when comparing funds within the same sector. Two managers may have delivered sort of similar returns, but one may have achieved those returns with significantly lower beta, which may indicate a more efficient balance between risk and reward. Another reason beta is useful is that it helps investors understand what to expect from a portfolio during different market environments. A high beta portfolio is likely to behave differently from a low beta portfolio. Neither approach is automatically right or wrong. The suitability depends upon the objectives of the investor and the role the fund is expected to play within a portfolio. However, as with every metric we have discussed, beta should never be interpreted in isolation. A low beta doesn't automatically mean the fund is safer, and a high beta doesn't automatically mean a manager is necessarily reckless. It simply provides another piece of information that helps us understand how the portfolio behaves relative to the broader market. Ultimately, beta helps answer an important question. How much of the fund's performance is being driven by market exposure? Because before we attribute success to manager skill, we first need to understand how much of the outcome may simply be explained by the market itself. And once we understand market exposure, we can begin examining another area that investors care deeply about. Not volatility, not benchmark relative performance, but actual losses. And that's where maximum drawdown becomes quite useful. Now, unlike some of the metrics we've discussed, Maximum drawdown is incredibly easy to understand because it answers a question that every investor immediately relates to. How much money could I have lost? Max drawdown measures the largest peak to trough decline experienced by a fund over a particular period. In simple terms, it tells us how painful the journey could have been for investors. But why this is important? Because investing is not just about returns, it's also about behavior. Many investors can tolerate volatility when markets are rising, as I said before, but what often matters more is how they react when markets are falling. A fund that falls 10% requires a recovery of around 11% to get back to where it started. A fund that falls 50% requires a recovery of 100%. The deeper the drawdown, the harder the recovery becomes. This is why professional fund selectors pay close attention to drawdowns. Not because they expect managers to avoid every market decline, that's impossible, but because drawdowns tell us something important about risk management, portfolio construction, and investor experience. Ultimately, investors don't experience standard deviations, they don't experience statistical models, they experience gains and losses. And max drawdown provides one of the clearest measures of what those losses may look like in practice. Now, as we have seen throughout this video, no single metric provides all the answers. A high Sharpe ratio on its own isn't enough. A strong Sortino ratio isn't enough. A high information ratio isn't enough either. Alpha, beta, tracking error, and drawdown all tell us something slightly different. So the role of a professional fund selector is to bring all of these pieces together and form a balanced judgment. Because successful fund selection is rarely about finding a perfect manager, as I said at the beginning. It's about identifying managers who possess the right combination of people, process, philosophy, discipline, risk management, and performance characteristics. And that's exactly why fund selection is both an art and science. Throughout this video, we have focused on the theoretical foundations of fund selection. We have discussed how professional fund selectors think. We have explored the qualitative framework used to assess managers and organizations. And we have introduced some of the most important quantitative measures used to evaluate investment performance. But theory is only the beginning. In future videos, we will move from concepts to application. We will look at real-world examples. We will examine actual funds. We will explore how professional fund selectors screen large universe of funds and gradually narrow them down to a short list of potential candidates. We will look at the practical use of fund screeners and filtering tools. We will discuss how to interpret that data, and we will walk through the process of building conviction in a fund manager. We will also explore one of the most important topics in investing, portfolio construction. Because selecting a good fund is only one part of the challenge. Building a diversified portfolio of funds is an entirely different discipline. And we will look at how professional investors think about portfolio construction, but without providing specific financial advice or investment recommendations. If you have made it this far, thank you very much for watching. I hope you have found this introduction to fund selection useful. And if you enjoyed this video, please consider liking, subscribing, and sharing it with anyone interested in investing, fund research, or portfolio construction. As always, remember, good investing isn't about chasing best performing fund. It's about understanding the people, processes, and decisions that drive long-term outcomes. Thank you very much for watching, and I'll see you in the next video. All the best.